Welcome back, future ACCA affiliates. In today's financial reporting masterclass, we are diving deep into Chapter 8, Inventories and Agriculture, covering two vital international accounting standards, IAS 2 and IAS 41. Whether you are sitting Section AB or working through a Section C financial statement preparation question in your FR exam, inventory valuation and biological asset classification come up constantly. In this video, we will break down every single syllabus requirement, highlight the tricky exam traps examiners love to test, and make sure you walk away with 100% confidence. Make sure to hit that subscribe button, grab your notepad and calculator, and let's jump straight into Section 1. First up is IAS 2, Inventories. Inventory is often one of the largest current assets on a company's statement of financial position. Because of its direct impact on cost of sales and gross profit, getting inventory valuation right is critical for financial reporting. The golden rule of IAS 2, and one you must memorize for your exam, is that inventory must be valued at the lower of cost and net realizable value (NRV). Why do we do this? This is a direct application of the prudence concept. Under prudence, we must never overstate assets or understate expenses. If the expected cash we can make from selling inventory falls below what it cost us to buy or make it, we must write it down immediately. Here is a crucial exam point. You must calculate the lower of cost and NRV on an item-by-item basis or category-by-category of similar items. You cannot aggregate total costs across all products and compare it against total NRV. That is a classic distractor in ACCA multiple choice questions. So, what actually goes into the cost of inventory? On the left side of our screen, you see the costs we capitalize into inventory asset value: purchase price after deducting trade discounts, non-refundable import duties, carriage inwards to bring raw materials to the factory, and direct labor plus production overheads. Now, look closely at the right side. These are costs IAS 2 strictly forces us to expense in profit or loss. 1. Abnormal waste. Inefficiencies cannot be hidden in asset values. 2. Storage costs, unless storage is necessary for the production process itself, like aging cheese or maturing wine. 3. General administrative and selling overheads. Top exam tip: fixed production overheads must be allocated based on normal operating capacity, not actual low production. If a factory produces fewer units during a downturn, allocating fixed rent over fewer units would artificially inflate unit costs. IAS 2 forbids capitalizing inefficiency. When goods are interchangeable, tracking every single batch becomes impractical. IAS 2 permits two primary cost formulas. FIFO, first in, first out, assumes the oldest inventory is sold first, meaning closing inventory on your balance sheet reflects the most recent purchase prices. AVCO, weighted average cost, calculates a weighted average cost per unit across all available units. Warning: LIFO, last in first out, is strictly prohibited under IAS 2 because it understates inventory values during inflation. Also keep in mind for theory questions, during periods of rising prices or inflation, FIFO produces a higher closing inventory value and a higher reported profit compared to AVCO. Now let's examine net realizable value, NRV. NRV is calculated as the estimated selling price minus any estimated costs to complete the item, minus any selling and distribution costs. If NRV drops below cost due to damage, obsolescence, or falling market demand, we must perform an inventory write-down. The journal entry is debit, cost of sales in profit or loss; credit, inventory asset in the statement of financial position. If in a future period market conditions improve and NRV recovers, IAS 2 allows you to reverse the write-down, but only up to the original cost limit. Now let's turn to the second major part of Chapter 8, IAS 41 Agriculture. Agricultural accounting has unique rules because biological assets naturally grow, degenerate, and procreate over time. To succeed in IAS 41 exam questions, you must master these three classifications. 1. Biological assets, living animals or living plants, such as sheep, dairy cattle, timber trees, or salmon in a fish farm. These fall under IAS 41. 2. Agricultural produce, the harvested output from biological assets, like wool sheared from sheep, milk collected from cows, or harvested fruit. At the point of harvest, this is measured under IAS 41. 3. Bearer plants. This is a huge favorite for ACCA examiners. Bearer plants, such as grapevines, tea bushes, or rubber trees, are held solely to bear produce for more than one period and will not be sold as scrap. Bearer plants are accounted for under IAS 16 property, plant and equipment, not IAS 41. However, the fruit growing on the bearer plant remains under IAS 41. How do we measure biological assets? Under IAS 41, biological assets are measured on initial recognition and at each reporting date at fair value less cost to sell, FVLCTS. Unlike IAS 16, where revaluation gains go to other comprehensive income, OCI, under IAS 41, all gains or losses arising from fair value changes are recognized immediately in profit or loss. In rare cases where fair value cannot be measured reliably on initial recognition, the asset is measured at cost less accumulated depreciation. Let's look at how IAS 41 hands over the baton to IAS 2 at harvest time. Stage 1, pre-harvest. While the biological asset is growing, it is under IAS 41 at fair value less costs to sell. Stage 2, point of harvest. The moment wool is sheared or apples are picked, the produce is measured at fair value less costs to sell under IAS 41. Stage 3, post-harvest. This point of harvest value becomes the initial cost under IAS 2. From that second onward, the harvested produce is treated as inventory and governed by IAS 2's lower of cost and NRV rule. When a business receives a government grant related to a biological asset measured at fair value, less cost to sell, IAS 41 sets two simple rules. Unconditional grants, recognized in profit or loss immediately as soon as the grant becomes receivable. Conditional grants, recognized in profit or loss only when the conditions attached to the grant are fully met. Note, if the biological asset is measured at cost, IAS 20 government grants applies instead. Let's summarize the key takeaways to score full marks in Chapter 8. 1. Always check whether a plant is a bearer plant, IAS 16, or a biological asset, IAS 41. 2. Remember to allocate fixed overheads based on normal capacity under IAS 2. 3. Never use LIFO, it is prohibited. 4. All fair value gains/losses on biological assets go straight to profit or loss. Thank you so much for watching. If this video helped clarify Chapter 8 for you, please give it a thumbs up, leave your questions in the comments below, and subscribe for more ACCAFR masterclasses. Good luck with your preparation.